Good evening, one and all. Welcome back. Yes, very good evening. Hi, Resham. So, students, we are now in a very interesting aspect of our IDT topic. And this topic, we covered initially all the crucial aspects which dealt with your supply, levy, exemption, then some technical issues like time of supply, then place of supply, and finally, we dealt with the calculation oriented topic, which included input tax credit. And then we had a session, if you all remember, exclusively on the practical discussion. Now today, let us shift ourselves to something different from what we have been doing. We have been till now majorly focusing only on the CGST, SGST laws, but now we will go towards the IGST law more. So our topic for today, the first topic for today is import export under GST. And thereafter, we will try and explore the other topic, which is refunds, right? Now, before that, anybody of you has any doubts, any queries in whatever you have studied, you may please put it across to me. Anyone, any questions or doubts, students? Students, I am asking you, in case you have any questions, because now you would have started revising, you would have started studying. So, no questions, students? Anybody? No? Okay, take it. So let me take you further ahead in this topic. Now the topic today is import export under GST. Import export under GST. Now we have to understand GST law covers both goods, services, both. So when we talk about anything under GST, be it import export, it would always be for both aspects separately. One is import export of goods, import export of service. Now, why this will be different? For this, we need to first understand something very important and interesting, that when we talk about import export of goods, for that actually we do not require the GST law. It is already there in the form of Customs Act. So the Customs Act, which is also part of our syllabus, is already there, which is providing for the provisions relating to import, export of goods. However, there was no specific law for import, export of services. Then we had the service tax related laws, which was per se originally the Finance Act 1994, Chapter 5, which became the parent act, you can say, for imposing levying service tax. And from there, we got the concept of import export of services, which is now continued even under GST. So when you read the GST law, which is now a unison of both the goods related laws and the service related laws, you find that there are striking differences between few aspects, especially when it comes to differentiation between goods and services. So let us, with this small background, go and delve deep into the subject. Just keep at the back of your mind, when you're reading anything relating to import export of goods, be sure that whatever analogy as far as the meaning, the concept we are drawing in GST, it is coming from your customs law. So there is nothing which the GST law is specifically providing for this. We are, you can simply say, replicating or copying it from the customs law. But when it comes to services import and export, there is no other law which is providing for it. So basically everything right from the concept to its application and implication, everything is provided for in the GST law itself. So let us try to discuss this. So we are on the revision part of this chapter. So firstly, import and export under GST. So GST being a business tax, we also call it as transaction tax. Import, exports is also a part of it, a part of business, a part of transaction. So we have to also analyze the impact of GST on that. Now, provisions in the GST law seek to provide level playing field to domestic suppliers vis-a-vis international suppliers in case of import. And when it comes to export, same for providing a competitive advantage outside India, because our exporters would be competing with firstly the domestic manufacturers of the country where we are exporting and plus the international suppliers. So the perspective with which any law is drafted when it comes to import export is keeping both the things in mind. One, when we are importing something in India from outside, we have to ensure that our domestic players should get a level playing field with the international players. And similarly, when we are exporting something outside, we have to again ensure that our manufacturers who are now going to compete outside India should get a competitive advantage. With this background, you have multiple things which are part of the GST law. And when it comes to import export of goods, also part of the customs law, and then FTP, that is foreign trade policy. Now, starting with imports, and it is import whether it is of goods or service. First thing, what is the treatment? It is treated as interstate supplies, and once it is interstate supplies, it is liable to IGST. Now, this analogy is drawn or is coming from two things. One, when you read the constitution where amendments were made to incorporate GST, so we had article 246A. When you read article 246A, in that there is a specific carve out saying that whenever there will be an interstate transaction, it will always be only with the parliament because you have to levy IGST. So the levy always remains with the parliament. But when it is not any interstate, that is, it is intrastate, both state and center, both parliaments are given concurrent powers. This is what is coming out from Article 246A. Then we go to the other articles. There is a specific reference of import, where it says that import, whenever you're talking about transactions of import, it will always be under the parliament domain and the parliament will be having the rights to levy tax. Now, from constitution, when we come to the GST law, in the GST law also, when it comes to import of goods or import of service, there is a specific reference given that import of goods and import of service will always be regarded as an interstate supplies. And once it is interstate supply, it is leviable to IGST. So now in case of import of goods, importer of goods pays the IGST. Similarly, in case of import of service, again the importer of service pays IGST, but there is a differentiation. The differentiation in both cases, importer is paying the IGST, but the difference is import of goods is routed through the customs law. And when it is routed through the customs law and you follow all the custom provisions, the impact of that is under the customs provision, you have to file bill of entry. Now I'm presuming that you all remember somewhat of customs law, though we'll be doing the revision later. So in case of customs, you file the bill of entry for clearing the goods. At the time of clearance, you have to pay the first basic customs duty, all the custom related cess, any type of anti-dumping or any other type of protective duties, and along with that you have to pay IGST. When I'm saying you, I mean importer. So the importer, while clearing the goods, has to pay the customs duties alongside the IGST leviable on import. Importantly, this is paid by the importer, that is, you can say in the language of GST, the recipient, but it is not falling in RCM. Though effectively, same like RCM, the recipient is paying the tax, the importer is paying the tax, but it is not falling in RCM for the reason that it is not covered either under section 9394 or section 5354 of IGST, 9394 of CNS, 5354 of IGST. It is not covered there. Rather, as per section 5.1 of IGST, which is the charging section, there is a proviso of 5.1 which says that in case of import of goods, only goods, the provisions of customs law shall apply when it comes to their levy, valuation, procedure, etc. So it has shifted the levy to customs law, and because under customs law the importer is liable to pay, hence effectively the importer pays the IGST on import of goods, but it is not covered in 9394, 5354, so it is effectively not RC. Secondly, when it comes to import of service, since it is specifically covered in 5.3, that is by way of notification, it is brought under RCM. Hence, here also importer pays, but here it is taking the color character of RC. So this is what is a differentiation which we have to keep in mind. Now there is a small exception. The exception is in relation to import of OIDER services, which is by an unregistered non-taxable recipient like you and me, who are non-taxable, and we are also unregistered. Now I'm registered, but let us say in your case you are unregistered under GST, also you are a non-taxable recipient. Now when you are taking any online services like you are taking Netflix or any such other OIDER services where the supplier is sitting outside and the recipient is inside, that is all of us. If you are an unregistered non-taxable recipient, then in case of this one import service, the RCM is not applicable. Here the foreign supplier is required to take a compulsory registration under India, either by himself or like in case of all these Netflix and all these portals, they have made some agent or they have started their own office here who is taking care of the liability, because they are the one who are made liable to pay GST. So this is one, you can say, exception to import of service where importer is not liable to pay tax under RCM. Any questions up to this point, students? Students, any questions in this? Whatever I have explained, the differentiation between import of goods, import of service, especially the differentiation when it comes to RCM. No? Great. So let us move ahead. Now we go in particular to details. We start with import of goods. Firstly, if you recall the topic of place of supply, in place of supply, Section 11 of IGST Act dealt with the place of supply for import and export of goods. And it said that in case of import of goods, the place of supply is location of importer. Interestingly, it has not said location of import. There is a difference, or there can be a difference between location of import and location of importer. How? Let us say I am staying somewhere in interiors of India. Let us say I'm staying in Mahabaleshwar, where there is no port airport. So my goods which are imported are coming to the Bombay port, and from Bombay port they are transported to Mahabaleshwar. Now in this particular case, the location of import is Bombay port. It may be your Delhi airport, it may be your Gujarat port, and the location of importer is in Mahabaleshwar. Now, interestingly and importantly, the GST law has very carefully crafted the law in such a manner that as an importer, if you are importing goods, the place of supply will be your place and not the place of import, which may fall in different state. Why this is done? So that tomorrow you do not lose the benefit of ITC on the IGST paid on the import. So that is why very carefully, instead of saying place of supply is location of import, they have said place of supply is location of importer. Now, when we talk about the Imposition of IGST on import of goods. Interestingly, Section 5 of IGST law is the levy creating section. However, as I had mentioned earlier, Section 5 bracket 1 proviso had said that for import of goods, the levy collection, in fact, even the valuation, everything would be done in accordance with the Customs Act, similar to how levy is done for the other imported goods. And this levy would be in addition to the customs duty, which are levied on imported goods. So all types of basic custom duty, custom related cess, etc. Over and above that, you'll be paying IGST, and it will be leviable at the rate at which similar goods are levied when supplied within India. So IGST would be levied at the rates which are applicable in India. Now, important is there is a confusion that if 5(1) of IGST Act has shifted everything to the customs law, saying that for import of goods, levy, the procedure, the mechanism, the valuation, everything would be as per the customs law, then does this IGST becomes a customs duty? The answer is it is not becoming a customs duty. It always remains IGST, with the only difference that the mechanism, including levy, has been as per the customs law. This is very logical, because if I want you to pay the duty at the time when you are paying the other customs duty, I want you to pay the IGST also, then by default, I'll have to shift everything to the customs law so that the application becomes easier, so that your mechanism of paying customs duty, computing customs duty, and equally IGST should not differ. Otherwise, it will happen that for customs duty, you are taking some other value, there is some other time of supply for that, and for IGST on imported goods, there is something else. So it would create a problem for the importer also, and later on for the tax authorities also. So just to bring uniformity in the procedural part, they have equated everything of IGST on import of goods with customs, but that does not changes the nature of the tax. The tax always remains a GST tax, that is IGST. Now, at what point of time IGST will be levied and collected on imported goods? The answer is same when the duties of customs are levied and they are collected. That is when you file bill of entry, the final bill of entry for home consumption, and these goods are cleared for home consumption, because that is what is the trigger point even for the levy and collection of the basic custom duty and custom related all taxes. So the timing has been equated with customs, and that is what was the purpose by which, or because of which, Section 5(1) proviso of the IGST Act has shifted everything to the customs law. Now comes the most important point. The most important point in this is when we talk about the amount or the value on which this IGST would be computed, would be payable, it would be again as per the customs law. Now, when we talk about customs law, in customs law, section 14 of the Customs Act is the section dealing with valuation, which requires you to go to the customs valuation compulsory. So you determine the value as per section 14 of the Customs Act, read with the custom valuation rule. In that value, or firstly on that value, you compute the basic custom duty and all other taxes which are leviable alongside the customs. Now you add both these, the basic customs duty and any other amount which is leviable, payable at the time of import, to the values again as per the customs law, not as per the GST law. And the total of these three becomes the value for computing the IGST. And if any GST compensation to states cess is applicable, even for that. Now here in this pictorial representation, you'll find that here minus is given. So minus is given to signify that in case the value is inclusive of GST, like how we say MRP is including all taxes. So if the value is including GST, then you will have to remove GST to find out the taxable or the assessable value. This rule is applicable even for domestically supplied goods or service, that you have to compute the value before GST. So even in case of import, in case the value is given lump sum in the question, back calculation you have to do. to remove the GST. And in case any of these duties are not added, you have to include all this. So basically the total of these three is your assessable value or taxable value for the purpose of computing IGST on imported goods. Now, in case of import, you have a special provision whereby when the goods come to the port, you file bill of entry either for immediate clearance for home consumption, or you are given a choice whereby you can remove the goods from the port and keep it with customs only in the customs bonded warehouse. And then at a later period in time, you can pay the customs duty and clear the goods for home consumption from this warehouse. Now, in case your goods which are imported at the Mumbai port, or let us say for this matter, the Gujarat port, and then they are shifted to a custom bonded warehouse in Pune where they are kept. And then in future, whenever you want, you get it cleared for your Mahabaleshwar unit. In this case, the question is when you are supposed to pay the IGST. Again, the answer remains same. The IGST is payable at the time when these goods would be finally cleared for home consumption. Why? Because that is the time when even the customs duty would be leviable and payable. So you have to equate it with customs. Now, in this particular case, let us say I imported the goods. I kept it in the bonded warehouse in Pune. Till this point of time, there is no customs, so there is no IGST. Now, after 6 months, I am supposed to clear it and take it to my Mahabaleshwar unit. In the meantime, you approach me for purchase of same goods, saying that you need those goods, and we negotiate a price at which I wish to clear or sell, not clear, sorry, sell the goods to you. Now, interestingly, the goods are still lying in the custom bonded warehouse. You don't want it cleared from there. You say that let it be there. Whenever you need, you will clear it. But in the meantime, you want me to sell the goods to you. Now, in this particular case, what I am doing is I am supplying warehouse goods to any other person. In this case, it is you before the final clearance for home consumption. Now, the question that was arising in this relation was that when I'm selling these goods, which are actually physically in India, they are in the bonded warehouse, which is in Pune, Maharashtra, and I'm supplying it to you. Is this a taxable supply? For this, earlier there was no provision in Schedule 3. So when this anomaly was brought to the notice of the council proposed to amend the law and they added an entry in Schedule 3 whereby now such a transaction that goods which are kept in the customs bonded warehouse until they are finally cleared for home consumption, if they are sold to any other person, this sale, this supply will not be treated as a taxable supply, or it will rather not be treated as a supply itself because it is covered in Schedule 3. Importantly, value of such inbound sales are also not included in the value of exempt supply for the purpose of reversal of ITC under Rule 4243. Now, when ex-bond bill of entry is filed for clearing such warehouse goods for home consumption. So now finally, these goods are cleared for home consumption from this warehouse. Now we all know alongside the basic customs duty, even the IGST would be leviable. Now the question is, it would be leviable on what value? Now here there could be two scenarios. Scenario one, the original importer who had imported and kept it in warehouse, he himself clears the goods. Scenario 2, he has already sold goods to you, that is some other person, and you clear it finally from the customs warehouse. In this case, the answer is if I am myself clearing the goods, then what is the value? The value is the value again as determined for the purpose of customs, adding to it the basic custom duty and other custom related duties and taxes. And on that total, we compute IGST. However, if in between I have sold goods to you, then the customs duty would be computed on the value at which I have sold to you, one, or the value which is determined by our formula, that is value as per customs plus basic plus any other time, whichever is higher. So one is the value as per customs plus the customs duty, etc. and second is the transaction value at which I have sold it to you. Out of this, whichever is higher, on that value, the IGST would be computed when these goods are finally cleared from warehouse for home consumption. Next comes another concept, that is taxability of high C sales. Now, firstly, what are high C sales? In this case, you have to first understand that high C sales means while the ship is still in the seas, before the goods have reached our customs port, before they have been unloaded, if between the time the goods are already leaving the foreign country and before they are reaching Indian port, I, the importer, sells the goods to you. So, same example, I have ordered the goods. They are supposed to be coming from Russia. While the time the goods are still in the high seas, that is, I've already purchased it, but they are still in transit as per our accounting sense. They have not yet reached Indian ports. Now you place an order for the same goods to me. I have one choice. I'll say, okay, wait for 10 days, let the goods come, I'll clear it and I'll give it to you. You say, sir, don't worry. You sell it to me now. I will go and clear the goods. I'm even more happy because I'm afraid of all the procedural hassles at the customs port. So I say, fine, very good. I sell the goods to you by making an invoice on you, and you can then go and clear these goods. Now the question is whether this invoice which I'm raising will be a tax invoice, will be a GST invoice. The answer is no. Reason is this particular supply, which is now called as a high C sales. Why? Because I have sold the goods while they are in transit. They are still in on the way to India. While they are in the seas, that is what is called as high C sales. I sell the goods to you, and this will not be treated as a taxable supply. Why? Because it is again part of Schedule 3. It is taking the color of a no supply transaction, and there will be no GST. Again, on what price the IGST is to be computed? Same rule, the IGST will be payable on price paid by the last high C sale buyer who files the bill of entry for home consumption. So let us say I have sold it to you. Now let us say before the goods reach India, you have further sold it to somebody else. In that case, the last buyer at whatever price he had purchased the goods, that price will become the base price for determining custom duty and then afterwards IGST. Then comes the third type of transaction. The third type of transaction is taxability of third country shipments, which we call as out and out sale, which is also called as here triangular trade. Now, what is this? So, I'll give you a real life example. Today, let us say US has put sanctions on China, saying that US or any person in US will not buy particular goods from China. Like this was also the case with Russia. When Russia started war with Ukraine, many European countries imposed those sanctions that they will not be buying oil from Russia. Now, practically, without Russian gas, without Russian oils, these European countries cannot survive a day because they themselves cannot produce so much of gas and what do you say, the oil. So by default, they will require it from Russia. Now, what happened? Since they were not allowing Russia to buy it, they were not allowing directly to buy from Russia. What Russia did was, Russia showed that those supplies are made to India, and then India was making supply to that particular country. Now, in case of oil, the scenario was we were buying the crude oil, we were doing some refining, and after refining, we were selling it to the European countries. So that is not coming over here. But let us say in case of gas, or in case of any other item, the goods are directly going, let us say, from Russia to European countries or from China to US. Only we act as a middle person. Means on paper, yeah, on transaction, it is shown that Russia is selling to me and I am selling to the European countries, or China is selling to me and I am selling to the European countries, whereby Yes, Ajit ji.
Sir, this is Sir. I'm Dr. Rashmi Goel.
Oh, yes. Good
How
evening,
are
ma'am.
you, Mr. Podar?
Yes, ma'am. Good evening.
I just want to make a small announcement in the
Please,
interest of the students. In case if you
please.
allow, let me make an
Allez, ma'am.
announcement.
Please, please.
Yeah, dear students, we would like to inform you that from next week we are having an open house query session for each of the final subject from 4 to 5 on each day. So on Monday you will be having the class of financial reporting, thereafter on Tuesday paper 2 advanced financial management, thereafter paper 3 for auditing, thereafter for direct taxation on Thursday, and on Friday we will have indirect taxation. So I request all the students and whosoever your friends are, it is not necessary that only the students who are associated with LVC would be joining this open query session. Any student all over the India, whosoever is preparing for final examination, if they have any kind of a problem, please please join us over there, and my faculties would be resolving all your problems. I believe all the students would have heard it, and they would avail these services. Thank you. Thank you,
Thank you.
Poda, Mr. Poda.
Thank you. Yeah. So, students, I was giving you example, a real life example where this is happening for varied reasons. So, on paper, the transaction is so crafted that I show that I'm buying from Russia, I'm buying from China, and I'm selling it to the European countries or US. But the goods do not physically touch the Indian territory. That is why I said it is an out and out sale, whereby the goods are physically directly moving from this originating country, in my example, Russia or China, to the consuming country, in my example, European countries or the US. Now, in this particular case, again, an issue was, again, a doubt was that whether this can be taxed in India. Now, the challenge was that since it is a transaction of goods, which is, as I already mentioned at the start, is regulated by the customs law. Customs law require that the goods come into India, you clear into India, then only it is import and import duty is applicable. Similarly, when goods move out of India and they are sent to any other country outside India, then only it will be export. Now, in this case, physically, the goods neither entered India nor they were dispatched from India to a third country. So it was not qualifying from the customs angle and hence even the GST angle, because GST uses the same definition of import export of goods as in customs, that it wasn't satisfying the definition of import export, and hence there was no levy which was legally constitutionally possible. Hence, in the wisdom and matching with this particular legal position which is coming out, the law is so drafted that this transaction, which is an out and out trade, is put in Schedule 3. So it is considered as a Schedule 3 item, right? That is, such transactions are considered neither supply of goods nor supply of service. So on this, neither there will be any type of import nor there will be any type of export related in case of taxes. Now, now coming to something which got amended very recently in 2023. We just saw above that there was a provision relating to OIDER. But now what we are going to discuss is not relating to OIDER. It is relating to something else, which is online money gaming. Now, what is this online money gaming? Firstly, one is there is online gaming and the other is online money gaming. What is the difference? See, when you say online money gaming, it means wherever some stake is put by the player. Now, the stake may be in the form of money, it may be in the form of virtual digital assets like digital coins or any of the digital products. So, you are putting a stake for playing a game, for participating in any game or any event. Like now, when there was this IPL going on, we had multiple ads of many celebrated players and even some celebrated film stars about make your own team, Dream 11, make your team contest. And in that, virtually what I was watching, they were being given per day crores of rupees as the winning prize. Per day means per match. Now, what was all this? This was a type of an online game whereby you as a player were supposed to put some money as stake, maybe 500 rupees, maybe 100 rupees, maybe 50 rupees, and enter this contest or make your team and participate in this contest, in this event, in this game. That is what is online money gaming. However, where no such money stake is involved, like today, we all play Temple Run, or maybe you may have played. I don't know whether presently you're playing or not, because that was the last online game I played, so I remember only that name. So you play this Temple Run or the Subway Surfer, where you are playing a game, and let us say you are playing it online. There is some online portal on which you can go and play the game, but it does not have any money stake. So there is no competition. You just play. Maybe you pay the charges for playing for that 1 hour, 2 hour. There is some subscription. You take the subscription so you can play, or you have to buy the coins to play. That's it. But there is no contest. There is no winning or losing. That if you win, you'll get so much of money back. Then it is merely online gaming. So there are two things: online money gaming, online gaming. Once it is online gaming, it is part of either. What is the tax treatment of Netflix? What is the tax treatment of Silver Music app? The same thing is tax treatment of your online gaming. However, where there is some stake, you participate in that game, putting a stake where there could be either win or loss, that becomes online money gaming. Now, from 2023, 1st of October, there is a new scheme. I'll use this word new scheme because a proper mechanism has been put in whereby you are, as a you can say online gaming company, put certain procedural conditions, and most important, they have now specified that the tax would be levied at the rate of 28%. First point. Second point, most important, this tax would be levied, important, pay attention, this tax would be levied as or on, not as, on the entire amount of deposit that you have kept in the wallet. So let us say you keep 100 rupees as deposit in your wallet. You transfer it from your bank account. Immediately on that 100, 28 rupees is taken by the online gaming company and given to the government. So this amendment was brought in for online money gaming. Now, in this context, when the online gaming companies in India, there is no challenge. The challenge was when the online gaming companies outside India, like we call them as foreign online gaming companies, and there are many companies and there are many games. Now, in this particular case, students, it was a challenge which was faced because many times the players like you and me would be unregistered, would be a non-taxable person. So how will this player pay tax under our SIM? Because this is also like import. So first interesting and important thing that you have to notice, or rather I'll not say interesting only, it is strange also, that online money gaming, as per this new amendment from 1st October, is given the character of supply of goods. How? They have included this online money gaming in the definition of specified actionable claims. And you all know that actionable claims have been treated as goods under GST. So interestingly and even strangely, online money gaming is classified as goods because it is treated as specified actionable. Having said this, the important part is, can it follow the customs procedure of import export? Definitely not, because it will never be passing through the customs. So that is where there is some anomaly in this amendment, where we'll see in future how things unfold. But as on date, it is regarded as supply of goods. Now, when a foreign online gaming company is providing any such contest or games or running such thing in India, same like order, they have been cast upon a responsibility that firstly, you have to pay tax under forward charge, because we cannot take it under reverse charge, because the players would all be normal citizens. They may not be registered because they all would be individuals. So there is very less chance that we can recover it from them. So the responsibility is on the foreign online gaming company only. And for this purpose, this new section 14A, which is parallel to section 14. And remember, we are now talking about entirely IGST Act. I mentioned this at the start that for a change in this chapter, what we are going to study is not CNS, we are going to study IGST. So in this particular case, this foreign online gaming company has to take a registration in India, has to comply with all the procedural requirements either by itself or appoint some representative who can do this, and then only they are allowed to operate their games in India. Otherwise, you know that this happened before also, that we blocked many Chinese apps. Recently, we blocked many Pakistani YouTubers and many of their web portals. So we have that technological possibility that we can anytime ban any online platform, channel, etc. So these online gaming companies have been put this condition restriction that if you want to operate your game, your portal in India, you should take registration in India. And for this, either you should have a physical presence or you should appoint a representative. Now, for this, they have made a simplified, unified single registration facility from where all these online gaming companies will get their registrations done. Now, what are the two options? First, if the supplier of online gaming does not have a physical presence. So first you should have a physical presence, matter is close. If not, if the person is available in India representing such overseas supplier online gaming, such person will be liable to pay GST. And if the person is not available in India representing such overseas suppliers, the supplier of online gaming is required to appoint a person in India only for the purpose of paying the tax. It means that either you be physically present in India. If you cannot be physically present in India, you have a representative. If you do not have a representative, sorry, you'll have to appoint somebody who takes the responsibility of paying your tax. If none of this is done, we will not allow your portal to operate in India and it will be blocked for access by public. So this is the provision brought in section 14A. Students, any question up to this stage? Because slightly today's topic is slightly offbeat. It is not your regular topic that you study. It is not your day-to-day study subject. It is slightly offbeat, but it is very interesting. Anybody has any questions or doubts up to this point? Okay, please put it across. Okay, Siddharth. Anybody else?
Sir, good evening,
Hmm.
sir. Sir, my
Yes.
query is about the if the goods are sold directly from the warehouse. Please explain this again.
Okay. See, firstly, they are not sold from warehouse. They are sold while they are lying in the warehouse. So as I gave you example, I imported the goods. I got it cleared from the Gujarat port, but I did not bring it to my factory, but cleared in the sense I just removed it from Gujarat port and kept it in the customs bonded warehouse in Pune. Now, when you keep it in customs bonded warehouse in Pune, in the eyes of law, the goods are still with customs. They are under the control custody of customs only. Correct? In this particular case, if let us say you approach me for buying those goods, I can do what? One, I can clear it from the warehouse and sell it to you. That is a different scenario. What we were discussing was that I sell the goods to you, being the goods in the warehouse only. So the goods lie in the warehouse, they continue to remain in the warehouse, but I sell the goods to you. And then in future, whenever the warehousing time limit is over, you can go and get the goods cleared and take the goods by paying the relevant customs duty and along with that the IGST. In this, what is your doubt, beta? Tell me.
Sir, my doubt is that when I pay the tax, how to calculate the value of goods? Is
That
it
is
the
what I'm
sales value? or
Yes, that is
the
what was the point, beta. So that is where our provision said that in this particular case, the value will be higher of the two. Why? Value as per customs valuation provisions plus the basic custom duty. That is what we studied for all imported goods. The value as per customs, I'll say. Second, the value at which I sold the goods to you. There are two values now, one as per customs and the real sale value. Out of this, whichever is higher.
okay, okay.
Understood?
Yes, thank you.
Great. Anybody else has any questions or doubts till now, students? No doubts? All clear? Great. So we move on to the next aspect in this. Taxability of goods which are imported by SEZ. We all know SEZ stands for Special Economic Zones. Now, what exactly special economic zone? You find the reference of this in income tax laws also. You find it in GST law also. What is it, SEZ? See, if I have to put it in a very simple words, it is a physical place in India, an area, but that place which is physically in India, because actually it is some part of India only, it is given a foreign status just for the purpose of application of taxation and other laws. Which means that I'll give you an example. I normally explain this as it is like Sri Lanka in India. This is just an analogy, means what? That some area is demarcated to be treated as SEZ, which may be any area. Like, for example, around your place, wherever you stay, there could be some industrial area where you'll find all industries at one place. That is what is called as industrial area. Now, similar to that, there is SEZ, which is also, you can say, an industrial area, only a demarcated area. But the difference is that that area is treated as if it is a foreign country, though it is physically in India. Now, somebody will say, sir, how this can happen? How can there be a foreign country within India? So actually, it is not a foreign country, it is Indian land only. But from the perspective of taxation and other laws, the status given to it is like a foreign country. So you just visualize for the purpose of understanding that within India, within the place where you stay, there is one area which is given a foreign country status. Now, what will happen if it is given a foreign country status? To understand, when you, who is in the area in India, that is where you are staying, is selling any goods or service to that area which is in your same city, but given the foreign country status. So when you are selling to them, what will be the nature of the transaction? The nature of the transaction will be like export. Though the goods physically remain in India, but since we have given that particular area a foreign country like status only for taxation, only for application of different laws. Hence, when you are selling or supplying any goods or service to them, it is like sending it to Sri Lanka. It is like sending it to any other foreign country. So whatever you are supplying there to any person who is invited there, it is given the treatment of export. Second point, similarly vice versa. If any person who is located inside that, which we call as unit in SEZ or unit of SEZ, when they are supplying to you, you are in the normal. Acha, this normal who is not SEZ, that is the other areas of India which is not SEZ, they are given the terminology as DTA, domestic tariff area. So what is this DTA? So this special area is called SEZ. Other remaining areas which are not SEZ, they are, for the purpose of now identification or giving them some name, they are termed as DTA, domestic tariff area. Now the purpose or the logic is that when you, that is the DTA person, supplies to a person in SEZ, it is treated as export. When the SEZ person supplies to you, for you it is an import. Now, interestingly, if this SEZ person is buying something from outside India, so it is like Sri Lanka, a person in Sri Lanka is buying some goods from US. How are we concerned? We are not concerned. Though physically this SEZ is in India, but since we have given it a foreign status only for the purpose of taxation law, hence what is written, goods imported by a unit in SEZ or a developer of SEZ for their authorized operations. Authorized operations means the operations for which that SEZ is given the license or permission is called as authorized operations. Then it is as good as a person in Sri Lanka is buying something from US. How is India concerned with that? So we should not levy any tax. But since that place is physically in India, hence, in order to equate this with the logic that we are understanding, they have said that we will treat it as import. Now, there is another person or another, you can say, status, which is EOU or 100% EOU. EOU stands for export oriented undertaking. Now, what is this EOU status? There are some units whose entire operations or majority of their operations is export. So either they purchase raw material locally, domestically, and manufacture final product export, or they import raw material, manufacture final product and export. But whatever is, their major output is export. These units, these industries can get themselves registered as EOU following the EOU bonding and registration procedure. Now, once they are given the status of EOU, what will happen again, just again for the purpose of understanding, you will treat that EOU unit as a foreigner. That is why again what is given, where goods are imported by this 100% EOU. So already that EOU is a foreigner. If that person is importing goods from again a country outside India, how is India concerned with that? Because for us, two foreigners are dealing. So that is why it is given that where goods are imported by EOU, that will be allowed to be imported without payment of the basic custom duty, additional custom duty, IGST, etc. So the treatment is similar. Correct? Then we come to the third aspect, which is baggage. Now, firstly, what is baggage? Baggage means your personal luggage. So whenever you are traveling, you carry some luggage with you. That luggage is called as baggage under customs provisions, and there is a separate chapter called as baggage rules. Now, what is this baggage? When you are traveling, now we are talking about foreign travel, either coming to India or going out of India. What you carry along with you is your personal goods. That is what is the baggage. It is not something which is meant for being traded. So, in the eyes of customs law, they have bifurcated the goods which are coming from outside India or going outside India into different categories. One is cargo. Cargo is what you import, export for trade. The other is what is your own personal baggage luggage, where at least the logic or the intention is we are doing it for our personal purpose. But if I am traveling outside, I'll need some day-to-day use items, which will include clothing, which will include my daily use accessories. So you cannot say I'm exporting it outside India. Similarly, if a traveler from outside India, tourist is coming to India or staying in India for 10 days, definitely he or she will bring along with him her different goods in the form of daily items. There may be laptops also, phones and chargers, which they are going to use while they are staying in India. Can you say they have imported and levy import duty? Answer is no. So even in the customs law, you have a separate baggage related provisions, and then you have baggage rules, which is basically to provide some exemption from the basic customs duty. So the general rule you can say is if you are bringing along with you your luggage, it should be brought or it should be allowed entry without any customs duty. Now, if we say this, then tomorrow what will happen, which was happening in some earlier phase, that people will start bringing along with them some very costly items, some valuable items, and they will say, okay, these are my personal use goods because now I'm carrying it in my baggage. So everything is personal or assumed to be personal. So there should be no customs. To avoid this, in the baggage rules, they have given some We call it as duty-free allowance. This is what you study in the customs chapter of baggage, where now the baggage provision says of customs law that whenever you are coming to India, we will allow you to bring along with you whatever goods you are carrying in your baggage, which is a bona fide baggage, up to a certain amount limit free. That is what is called as duty-free allowance. Now, that may be for used goods, it may be 100%, whatever are used is 100%, and whatever you are bringing new, let us say for your own use or for gifting to someone, there may be some limits. So, depending upon whether you are an Indian person or a foreigner, whether you are traveling from outside India or in India. One second. So, depending upon whether you are Indian, foreigner, traveling from which country to India, how many days you are staying outside, on all these bases, they have given different amount limits. And that is what is called as a duty-free allowance on which there is no customs duty. Now, to the extent where there is no customs duty, even the IGST and the related compensation cess is not levied. So where customs is not levied, IGST is also not levied. However, where you are bringing along with you whatever in your luggage in excess of the duty-free allowance. So now your baggage, you are calling it as baggage because it is coming along with you, but it is exceeding the allowance, the limit which is specified in baggage. In that particular case, the customs duty is applicable at the rate of 35%, the basic customs duty. Also, there is custom surcharge. And the question that remains is, what about then GST? So the answer is that wherever you are bringing goods in excess of the duty-free allowance, there is a constant or a fixed basic custom duty, which is 35%, and there is no IGST on that because you are actually not supplying, you are bringing it for your own use. So this is all about import of goods. Now we'll take a short 5 minutes break. So out of our total 15 minutes break, we'll take 5 minutes now and maybe 10 minutes again after 1 hour. So Ashok ji, just a 5 minutes break and then we'll restart at 6:05. goods. Let us now go to import of service, different aspects. Now, as I said earlier, the biggest distinction is between the nature. What is this distinction? Import of goods is rooted through customs law. The customs provision are applicable as far as the levy, valuation, time of supply, everything is concerned. But when you come to import of service, everything, levy, time of supply, valuation, everything is as per the GST provisions, because to this the customs provisions cannot apply. It cannot apply, right? Because the customs exclusively deal with goods transaction only. Now, keeping this in mind, let us understand the various provisions relating to import of services. Now, there are two possibilities under GST law. Firstly, now, acha, one very interesting point I just missed. So, let me just make that comparison also. When we talk about goods, for the purpose of levy of IGST on import, the question is whether import of goods have also to satisfy the definition of supply. Why I'm asking this question? Because under the customs law, the levy of customs is on import of goods, full stop. The word supply never existed in customs law, neither it is existing today. And we just discussed and concluded in the first section of goods that when it comes to import of goods, everything is as per customs law, starting from levy up to the final procedural collection, and in between everything, time of supply, valuation, everything. Now, when I say everything is as per the customs law, including levy, question is, can there be a levy of IGST on such import of goods which is not satisfying the criteria of supply? The answer is yes, because the levy is not on supply, it is on import of goods, even as per section 5 on proviso. So when we talk about import of goods, it fits fully in the customs law provisions. Whereas when you come to import of service, suddenly you come back to supply. And that is where this distinction becomes relevant, whether your import of service is for a consideration or it is without a consideration. This distinction we never discussed in the entire first category when we were dealing with import of goods, because as I said, for import of goods, the supply requirement itself was not there. And when supply requirement is not there, then you need not fill in all the limbs of supply, one of which is that it should be for a consideration. Now, when we talk about import of service, since it is not fitting or falling in the customs law, it comes to the GST law. And now all parameters of GST law shall apply, starting with the very first parameter that there should be a supply. Now, when we say that there should be a supply, the different limbs of supply is that first it should be one of the forms of supply, it should be of good service, it should be related to business, means it should be part of your business, and last is it should be for a consideration. Now, if it is a consideration, definitely it will be supply, provided if it is in the course or furtherance of business, right? However, when you read section 7, which is for the definition of supply, it has carved out some special provisions only relating to import of service. Now, in relation to section 7, if I talk about import of service, there are 4 scenarios that are emerging. Scenario 1, we have imported service which is for a consideration and which is in the course and furtherance of business. It is a supply as per 7(1)(a). So all limbs of supply is satisfied. It is import, so there is some transaction. It is a service. It is for consideration, and it is also in the course or furtherance of your business. So all limbs of supply satisfied. That import of services is a supply as per 7(1)(a) leviable to IGST. However, if I'm importing some service for a consideration, but it is for my personal use, not in the course or furtherance of my business, it does not satisfy 7.1. However, there is a specific carve out in the form of 7.1b, which says that even where it is not for the purpose of business, that is not in the course or furtherance of business, still 7.1b will treat it as supply. So the second type of supply for import of services where the import of service is for a consideration, but not in the course or furtherance of business. 7.1b, it is supply. Then comes a third aspect where the import of service is not for a consideration, that it is a free import. In that case, 7.1c read with Schedule 1, which is for deemed supply without consideration triggers. And in that, again, you have a special limit for import of service, which says that wherever you have imported service, which is in the course or furtherance of business, so that is now required, it is without consideration and it will be supply provided, one, it is in the course or furtherance of business, and two, it is from any of your related person outside India or your distinct person or your establishment outside India. So if you have a branch outside India or your related person or relative is outside India from whom you have imported this service for the purpose of your business, maybe without consideration that it is a free service to you, still it will be regarded as supply as per 7.1c. This is the third limb of import of service. And then comes the fourth limb of import of service where it will not be a supply. Why? Because two components are missing. It is without consideration also, and it is not in the course or furtherance of business also. If both the limbs are missing, then 7.1 ABC do not help. It is outside GST because it is no supply. Similarly, if it is without consideration, it should be in the course or furtherance of business. It is, but it is not imported from your related person or distinct person. Then also it is not a supply. That is what is mentioned in other cases. There are total 4 parts of supply when it comes to import of service. 7.1a, all conditions satisfied. 7.1b, where it is for a consideration but not in the course of business. That is, it is a personal import. 7.1c, when it is without a consideration but in the course of business and from your related person or establishment outside India, that is distinct person. And then last limb, in these 3 limbs, it is a supply, it is import of service, it is liable to IGST. In the last possibility, which is mentioned as any other case, when 2 elements are missing, then it will not be leviable to GST because it will then not satisfy supply. Now, having said this, the question comes is, what is exactly this import of service? Importantly, customs law does not apply, so there is no definition you are getting from customs law. Like for import of goods, we have definition coming from the customs law itself for import and export of goods. However, for import of service, there is no definition coming from the customs law. So the definition is exclusively from the GST law itself. What is the definition saying? That in order to be treated as import of service, the first requirement is supplier should be located outside and the recipient should be located inside. This is the basic requirement. But besides this, the most important requirement is that as per the place of supply provisions which are mentioned in section 13 of the IGST Act, the place of supply of such service should be falling in India. So supplier outside, recipient inside, place of supply is inside India. If all these 3 components satisfied, then only it is called as import of service. If any one component missing, it will not be considered as import of service. So this is the pictorial depiction of this. So 3 conditions, all 3 should be satisfied: supplier outside, recipient and POS should be inside India. Then only it will be import of service. Very important point is here, there is no condition of flowing of exchange. Like in case of export, there is a specific condition that foreign exchange should be coming into India. There is no such condition here. Now, who is the person liable to pay tax in case of import of service? Different scenarios. First, importation of order. where the importation is done by a non-taxable honorary recipient. If you remember, we had studied this at the start also. This is exception to RCM provision. So here, the tax is to be paid by the order supplier under forward charge. Next, importation of notified service through ECO. Here, the IGST will be payable by the ECO, like how we have 9.5, we have 5.5 also. Then, service of transportation of goods by a vessel from a place outside India up to the custom station of clearance in India, and it is done by a foreign shipping line. Now, if the contract is on FOB basis, IGST is payable by the importer. But if the contract is CIF, now once it is CIF, what is happening? The F, that is freight, is already included in the value of goods. And once it is included in the value of goods, you have already discharged custom duty on that. In that case, they are saying there should be no separate GST, that is IGST, applicable on the ocean freight. In all other cases, the residual cases of importation, IGST is payable by the importer under the RCM mechanism, right? Is this clear to all students? On this particular point, what we discussed just now, CIF and FOB, this is coming out from a landmark decision in case of Mohit Mineral by the Honorable Supreme Court, where the Honorable Supreme Court said that there cannot be a separate levy of IGST on the component of ocean freight paid by the foreign exporter to the foreign shipping line if the contract is a CIF contract. Why? Because if it is a CIF contract, then it becomes a composite supply under GST law. If it is a composite supply, the tax applicable to the principal supply, which is goods, shall be applicable. Then coming to importation of order service. One, if it is imported by a business entity or if it is imported by a person like you and me who is not a business entity. Now, in this particular case, where it is imported by a business entity, where both supplier of order and recipient both are in India, so it is not from a foreign supplier. If that is the case, when both are in India, then POS is location of recipient and tax is payable under forward charge. However, where the supplier of order service is outside India and the recipient is in India, but now the recipient is a taxable business entity, then the tax is payable under RCM if the place of supply is India. Next, where the recipient is a non-taxable online recipient, in that particular case, where both supplier recipient is in India and the place of supply is India, tax is payable by supplier under forward charge. So both are same in this case. But where the recipient is a non-taxable online recipient, supplier is outside, and the POS is in India. This is the exception. This is where the supplier has to take some administration. Even though it is a foreign supplier, RCM is not applicable in this case because the recipient is a NOTL, that is non-taxable online recipient. So in that particular case, the tax is payable by the order supplier. Now, provision or facilitation of order service by an intermediary located outside India. Now, what is this? So, the order service is not done by the order directly. It is done by some agent who is acting as an intermediary. This intermediary is also located outside.
Excuse me, sir.
Yes.
Your voice is breaking.
Is it a problem with everyone? Is my voice not clear to all?
Here
Yes.
it is okay, sir. Here it is okay.
Please, I just want to check whether there is a problem with
No,
my.
sir.
There is a fluctuation in your voice.
Now it is sometimes breaking, sir.
Okay, but you just let me know if something is not. I'll repeat. Fine.
Okay, sir.
See, in our place, it is stormy today. Maybe there will be net fluctuation because it is quite stormy in my place. No, if there is any challenge, I'll repeat that point again. Okay. So I was talking about this intermediary part. So now the service is order service, but it is routed through intermediary. Now, first possibility, the intermediary is located outside India and the intermediary arranges or facilitates supply of order service to an online, non-taxable online recipient. Then the provision is that this intermediary would now step into the shoes of the supplier, and now this intermediary would be required to obtain registration. So see, this will happen where, let us say, Netflix is not directly providing the connections in India. There is some intermediary. Now this is a old story. Nowadays, there is no such problem. Netflix is doing it directly, but there was a scenario or there was a situation some 20-25 years back where these foreign suppliers, they were not interested in coming and establishing their place in India. They were happy doing their business outside. But let us say I found that yes, this particular line of business has good scope in India. So I used to approach this foreign online order suppliers. Ki Baba, you allow me to provide your connections in India, take your subscriptions in India. So they used to say, okay, Vishal, what you want to do, you do, we are least bothered. So I used to act as an intermediary, a mediator, whereby I used to take the services from the order to further provide it to all the individuals in India. Like earlier, I don't know whether you have seen that, there was a time when we used to view all these channels through a mechanism called as the cable TV, where in every city there was a local cable TV operator. Now, he is not the main supplier of that cable TV service. It is one person maybe sitting at Delhi who is the main person, or it may be a person sitting outside who has taken the subscription of all these channels, and then with the permission of all these channels, which included many foreign channels, it is now having a network through which it is providing that service to individual household through these cable operators who are acting as intermediaries. So that is what is the concept, the simplest and real life example of intermediary in case of these order type of services. So where the location of this is outside India, then the order service supplier who is outside plus the intermediary is outside, the intermediary steps into the shoes of supplier and has to obtain registration and start paying IGST. Similarly, not involved in payment, terms and conditions and delivery of service, invoice clearly identifies the service and its supplier, then the responsibility for registration remain with the supplier. So the second type of intermediary is such that intermediary saying that, boss, I am not the supplier, I am only the mediator. And this is clarified from the invoice and all given. In such cases, the intermediary does not steps into the shoes of supplier, then all the registration and all headaches have to be done by the supplier himself. So what are the different case scenarios in relation to this? So person enabling supply of order services located outside India to comply with the responsibilities entrusted under the GST law. First, supplier or intermediary of order services, single registration is required under the simplified registration scheme. If representative is available in India, he can get registered and start paying IGST. If ECO has neither the physical presence nor any representative, then order supplier will have to appoint a person in India. Otherwise, the services can be blocked. Now, meaning of order, service whose delivery is mediated by an information technology over internet or electronic network. So there are two aspects or two limbs which makes up the order service. First limb is, it is such a service which can be given to you only through some information technology, using some information technology, like for example, internet, and it can be done over an internet or electronic network. So like how today all these online services that we are using is through some information technology network. So first, for order services, the first requirement is the services can be given only over the information technology network, which is a internet or similar network. Second most important part of this definition, when any online service will be ordered, because like right now also we are having this particular session going online. Is this session order? Answer is no. Why no? Because of second limb. First limb is satisfied. This service is mediated using some information technology through internet. So I am also sitting here in my place using internet. I am forwarding the lecture, delivering the lecture, and it is reaching to your place routed through ICAI. using the internet only. So A part of this definition is satisfied, but my service or this or LVC class will not fall in order. Why? Because of B. What is that? Services are impossible to ensure in the absence of information technology. Now there is one more aspect, that it cannot be, or this service should not require any human intervention. Now, if without the supplier, the service can be supplied only using internet, then only it is wider. Like today, when I'm giving this live using internet, it is not wider. But once this get recorded, and then you are subscribing for the recorded version, then importantly, the same service will become wider. So when I'm doing something live, the live cannot be wider simply because we are using internet. It is given through some information technology network. It is not wider. But whenever the service is in this particular same lecture, let us say it is recorded, and then you are viewing it or downloading it or accessing it using some internet or information technology. And then now no person is required because it is already recorded. Then when you access a recorded particular content, it will become an OIDER service. So this is a very important difference between any online service and OIDER. Next, services provided through e-commerce operator located outside India. What are the provisions? If e-commerce supplies notified services to the portal, which is the e-commerce, then it is required to pay IGST on those notified services. Now, how it will do this? Where ECO does not have a physical presence in India, one, if a person is available in India representing such ECO who is an overseas supplier, such person is liable to pay. And if a person is not available in India representing such overseas supplier, the ECO will have to appoint a person. This is parallel to OIDER. This is parallel to online money gaming. So the provisions are similar. What are these notified services? They are the one which you study in N5. What are they? You are booking some hotel, you are booking some cab. All these are those notified services. Now, registration and input tax credit in case of import of goods and services. One, important. For import of goods, do you compulsorily need to take registration? Answer is no. Why no? If you remember in my starting discussion, I had brought out this important difference that even though in case of import of goods and service, both the recipient, that is the importer, is liable to pay the IGST. However, in case of import of goods, it is not falling in the RCM provisions. And since it is not falling in the RCM provisions, there is no compulsory registration requirement. However, for all practical purposes, the importer takes registration. Why he takes registration? Please understand. The reason is the importer takes registration because if he is unregistered and importing some goods where IGST levy is compulsory, because on import there is IGST levy always, that will be collected at by the customs itself. If you are unregistered, you not get the ITC. So for all practical purposes, the importer will get registered, but from the perspective of law, registration is not made compulsory for import of goods. However, when you see import of services, since it is falling under RCM, registration is compulsory. So that is what is the difference between import of goods and service when it comes to registration aspect. If it is import of exempted goods, a person exclusively engaged in import-export of goods which are wholly exempt. We all know that there is an exemption from registration for such type of businesses. And in such a case, they need not take registration. And anyway, since it is exempt, there is no IGST, there is no question of ITC. Then in such cases, while importing, they may mention the PAN on the import documents. So now since they do not have IGST number, they can still import using their PAN number. That should be sufficient compliance. Further, ITC of IGST paid on imported goods available can be used for paying tax on outward supplies. ITC of compensation cess is available, but there is a restriction. It can be used only for making payment of compensation cess. So cess and cess only can be set off. Cess and GST cannot be set off, or vice versa. GST and cess cannot be set off. BCD and social welfare surcharge paid on the imported goods. This is part of customs, and customs duty credits are not set offable against the GST payment, so it's not available. And then the IGST paid on import of service. This is available. You can use it. And first you have to pay tax under RC, then you can set it off. Akshay is saying, sir, so import of goods, import of exempted goods will only have custom duty and zero IGST. Yes, Akshay. Assuming that there is no exemption under customs, we are only talking about exemptions of IGST or GST. Correct. Now, this we discussed at the start also that as per the provisions of the IGST Act, any import of goods or service is always regarded as an interstate supply. So that is what is mentioned. So what does 7.5 says? Supply of goods or service of both. First, when it is to or by SEZ. So either you are supplying to SEZ or SEZ is supplying to you. If you remember, I said that SEZ is like a foreign country within India. So if you are supplying to a foreign country, it is export. And if you are purchasing from foreign country, it is import. So by default, it has to be interstate. Second, when supplier is located in India, but the place of supply is outside, or in the taxable territory, but it is not an interstate supply. So all these three cases, it will be treated as interstate supply. Now, what is establishment of distinct person? Now, firstly, understand this. The concept under GST law is of distinct person. But who is a distinct person? The same person having multiple place of business, having separate registration. So same person means same PAN. Let us say it is a company having units in different states. Now the rule under GST law is if you are having your place of business in different states, you have to compulsorily take separate registration for each state. Now when you are taking compulsorily separate registration for each state, you have separate GST number. At least the first two digits, that is the state code, will change. In such a case, each of your GST registration numbers or each of your units having a different GST registration is considered as a distinct person. So this is firstly, what is a distinct person? Now, interestingly, there is one more concept in GST called as establishment of distinct person. Firstly, where this establishment of distinct person is used, it is used in the definition of export. It is used by determining the place of supply in case where you do not have a registration. So generally, outside India, even if you have a branch, it will never be registered under GST. It cannot be registered under GST. Logically, because outside India, GST law is not applicable. In such a case, that outside India branch cannot be called as your distinct person technically. So, for such branches, which are your own branches but not registered, are called as establishment of distinct person. So, one is distinct person, that is your own branch or unit having a registration. Second is establishment of distinct person, where it is your branch or unit but not registered. Now, mainly it will be all branches outside India which will not be registered. So they will be called as establishments of distinct person. Two, it may be a case where within India also there is some unit which is exclusively engaged in supply of exempted goods or services. We all know registration not required. Or there is a unit which is not having any outward supply. Why? It is a research unit only doing research. No outward supply. In such a case, within India also, you may have such units or branches for which there is no registration. Such are called as establishment of distinct persons. So, where any person has establishment in India plus any other establishment outside, or establishment in one state and any other establishment outside that state, or establishment in a state plus any other establishment within the same state. So three possibilities. One is outside India, you have a branch. Two, in one state where you are registered, plus in another state, there is another branch, but that state you have not taken a registration. Third, within the same state, two branches, but the other branch you have not taken a registration. Such unregistered units or establishments are called as establishments of distinct persons. Akshay is saying, sir, what if a group company has two establishments of member companies? See, firstly, Akshay, understand this. When I have multiple companies, like let us say the group is Reliance, the group is Tata's, All these are, we call them as a group. Why? Because they have multiple businesses and multiple companies. So you have a separate company of Reliance Energy, separate company for Reliance Textile, separate company for Reliance Telecom, and all their separate businesses. Like you even have the Reliance Petroleum. Now, all these are registered as a separate company. The moment they are registered as a separate company, these companies can never be called as distinct persons or even establishment of distinct persons because their PAN numbers are different. See, the concept of distinct person in GST is having the first precondition, I will say, that the PAN is same. Means the company is same. Then within the company has various branches or units. That is okay. I hope this is clear, Akshay. Now, now coming to the export side. Till now, majorly our discussions were revolving around the import side. Now on the export side. Importantly, under GST law, there is a very important concept called as zero rated supply. Also, there is a concept called as nil rated supply. Now, please don't mix between the two. Zero rated and nil rated are two different concepts. What is the difference? Nil rated supply means where in the rate schedule, in the rate notification, the rate put against your supply is nil. Importantly, a nil rated supply is covered under the definition of exempt supply. And the moment it is exempt supply, the repercussions of that is you are required to reverse your ITC, the common ITC, because of Rule 4243. However, if your supply is a zero rated supply, it is not firstly a nil rated supply and also it is not an exempt supply. Then the question is, what is a zero rated supply? So zero rated supply is a terminology where, important, pay attention, it is not necessary that the rate of tax is zero. I repeat, in case of a zero rated supply, which is a terminology, it is not necessary that the rate of tax is zero. Then why it is called as zero rated? It is called as zero rated because it covers some specified categories of supplies. Presently, there are two types of supplies which are given the designation, which are given the status of a zero rated supply. What are they? First is export. So whenever you are exporting either goods or services outside India, such export transactions are given the designation of zero rated supply. Two, if you are supplying goods, services to a SEZ unit or a SEZ developer, which they will be using for their authorized operations, such a supply is also designated as a zero rated supply. Why? Because, as you already know, these supplies are to a foreigner, at least in the eyes of law. SEZ is considered like a foreign entity in India. So whenever you are making supply to SEZ, it will be regarded as a zero rated supply. So presently only two supplies are designated as zero rated. Now, what are the options if your supply is a zero rated supply? One, you can make this supply without paying GST. For this, you require to have a bond or LUT. So once you have a bond or LUT, you can make this supply without adding any GST on that, without paying any GST on that. Obviously, it will be IGST because it is all interstate supply. Second option is you may make this zero rated supply by first making payment of the applicable IGST. Because see, as I said, zero rated does not mean that the rate is zero. So actually your supplies may have a rate, but since you are exporting it, since you are giving it to SEZ, we want to give you a special status of zero rated. Now, in both cases, there is a refund. But what is the difference? In case where you go for the option of export with payment, in that case, whatever IGST you have paid at the time of export, that is what is eligible as a refund. Second, where you are exporting without paying IGST, How? Under a bond or LUT. Now there is no payment of IGST on your outward supply. Still, there is eligibility of refund. Now the refund will be for what? Since there is no tax payment on your outward supply, you may have unutilized ITC balance lying with you. Because normally whenever there is outward supply, you pay the GST of that outward supply using the ITC. But if the ITC is not utilized, why? Because you are not paying any tax on outward supply because it is zero rated, then the law says, section 54 read with rule 89 says you can apply for refund of this unutilized ITC. So in both cases, there is a refund. The difference is, in case of zero rated supply, which is under the LUT option, the bond option, the refund will be of the ITC, which is remaining unutilized. If it is with payment of IGST, the refund straightforward is of the IGST which you have paid. Now, in order to ensure that your exports are genuine, you are not faking the exports by simply making fake documents, there is an important condition put that whatever exports you are claiming that I have made so many exports, the amount should be realized in convertible foreign exchange. This will be a proof that genuinely it is an export. It is not a paper transaction. And in case you cannot realize the sale proceeds, that is the export proceeds, within the time specified, in that particular case, whatever refund you have taken, you have to give it back along with interest within 30 days after the expiry of the time limit prescribed under FEMA for receiving the foreign exchange. So if you cannot receive the foreign exchange for your supplies, you will have to refund back the refund taken within 30 days. Now, what is the difference between exempted and zero rated? Exempt supplies are those which either attract payment or which are fully exempt or which are outside GST, that is not exempt. However, zero rated supplies are where there is some rate, and importantly, it is either exported or it is supplied to SEZ. Next, there is no tax on outward exempt supplies, and the input supplies used for making output supplies may be taxed. So there may be tax on the input side, but not on the output side. There is no tax on the output side. And if you have paid any tax on the input side, you can claim it as a refund. Credit of input tax need to be reversed if taken, and no ITC is allowed for exempt supply. Here, full credit of input tax is allowed. You can first take the credit and then you can even take refund that credit if it is not utilized. The value of exempt supplies for apportionment of ITC. Now, this is about the apportionment part. So once you have exempt supply, you have to apportion your common ITC as per rule 4243. However, a zero rated supply, even though no tax is payable on that, will not be considered as exempt, rather it will be considered as a taxable supply. So in the computation of that proportionate ITC reversal, a zero rated supply will be categorized as a taxable supply. So these are some differences. Going further in the exports category, what is the tax treatment under GST for export of goods or export of services? Chaksha has a question. Sir, are exporters available with these two options? Yes. See, exporters are available, but you are right. There is now in this with payment option, as you can see here, the reading also, they have mentioned that notified class of persons can make zero rated supplies, or notified class of goods services may be exported. So for with payment option, the government has brought in an amendment that they may restrict this option to certain people because they are saying we will allow it only to notified persons. Correct? So you're right, Akshay. But presently, there is no one which is who is not given this option because they have not used that notification. Now, what are the provisions for export of goods or service? First, it is treated as an interstate supply, and also it is zero rated. Second, ITC can be availed even if you don't have to pay any GST on the outward. Because why? Because it is a zero rated supply. Interestingly, very important, pay attention. Let us say your goods services are exempt under GST and you have exported these goods services. So they are exempt also, and you have exported, so they become zero rated also. Now the question is, if an exempt supply is exported, do you get the benefit of ITC? Because generally, if it is an exempt supply, you don't get the benefit of ITC. However, the exception is if it is an exempt supply, but if it is exported, the exempt supply now becomes a zero rated supply. And when it becomes a zero rated supply, you can take ITC and even eventually the refund. Now, definition: physical exports, it is taking outside India of goods physically. Deemed exports. Deemed exports is where you are actually not exporting the goods outside India. The goods remain in India only. But there are certain supplies which are notified as deemed exports. Now, what are these supplies? Supply of goods by a registered person using the advance authorization license, or supply of capital goods by the registered person using their EPCG license, or supply of goods by a person to the EOU. So supplies to EOU are not zero rated, they are deemed exports. And then supply of gold by specified banks or PSUs against advance authorizations. So these are the few notified supplies which will be deemed as exports. Now, what will happen for deemed exports? Are they zero rated? Answer is no. It means for all these deemed export supplies, whatever are notified, firstly, GST has to be paid. Now, important, since these are not actually exports or not actually zero rated, they are not always interstate supplies. They may be within the state supplies. So first rule is that it will not always be IGST. For what? For deemed export. So for deemed export, it will be a normal treatment. Your supply may be a C plus S supply if it is within the state, or if it is interstate, it will be IGST. Firstly, tax is applicable as per normal provisions. Now, once the tax is discharged by the supplier, for deemed export, the provision is either the supplier or the recipient, whoever has borne the tax burden, can apply for refund. This is what is the special point about deemed exports, that either the supplier or the recipient, whoever bears the duty, because the duty is obviously paid to the government. Now, if it is collected from the recipient and paid to the government, it means recipient has borne the incidence, recipient will get the refund. If supplier has paid the duty out of his pocket, not collected it from the recipient, obviously a declaration to the recipient has to be taken, then the supplier gets the refund. So the point is, in case of deemed export, the taxability is in the normal fashion. It may be C plus S also, it may be I also. And then after paying the tax, then either the supplier or recipient, one of them, whoever has borne the incidence, will go and apply for refund. Now comes another category which is called as merchant exporter. Now, who is a merchant exporter, or what is this concept? There is a possibility that you are exporting goods by purchasing it from me. So I may be the actual manufacturer, but I don't know foreign customers. So I cannot export, but you have the foreign customers. So what you do is you buy the goods from me and you export it. Now, in this particular case, you are acting as a trader. You are the real exporter. I am not a real exporter. I am selling the goods to an exporter. In such a case, there is an option, not a compulsion. There is an option that we can follow the procedure of merchant export. The effect is, if we follow this procedure of merchant export, then I, who is manufacturing these goods, will be selling the goods to you. We both are in India, applying the concessional rate of 0.05C, 0.05S, that is effectively 0.01%. And then you, who is a final exporter, can export these goods outside India. But for you, the compulsion is you have to export it only under LUT or bond because of the restriction of Rule 9610. However, now the government has scrapped Rule 9610. So presently, this restriction is also not applicable. Now, for me, who is a manufacturer and giving the goods to you, you are the merchant exporter. If I charge this 0.01%, what will happen? My inputs and purchases are basically at the normal rate 5, 12, 18, 28, but my output is at 0.01. So definitely I'll always have ITC accumulated. So I will be allowed to take the refund of this ITC under the category of inverted duty structure. You as a merchant exporter, when you export the goods, you are also allowed to get refund. And firstly, whatever 0.1 I am charging, 0.01, you are even allowed to take credit. So you will first take the credit of the tax which is I am charging, and then After exporting, you can follow the refund procedure and take the export refunds. Now, for following this whole mechanism of merchant export, whereby I will be selling the goods to you at a concession rate of 0.1%, for this, certain conditions have to be satisfied. What are these conditions? The condition is I will be making this supply using a tax invoice because there is no exemption. Most important, you should actually export these goods within 90 days from the date of my invoice. Again, most important, you, that is a recipient, should indicate my GSTN and my invoice details on the shipping bill. So on the shipping bill, this has to be made clear that you are an exporter who is only a trader, but the manufacturer is someone else. Further, you should be registered with Export Promotion Council. Fine. You, that is the recipient, shall place an order on the supplier for procuring the goods at concession rate and shall provide a copy of what? Of this shipping bill on which my GST number and everything is mentioned as a manufacturer to my jurisdictional officer. So once you have exported the goods for which 90 days are allowed, after exporting, you have to send a copy of the shipping bill to my jurisdictional officer. All this are the requirements. If all these requirements are met, then only whatever 0.1% I have charged is correct. If let us say tomorrow any of these requirements are not satisfied, then whatever 0.1 I have charged will be considered as short payment and the department can come and recover from me the difference. Difference means the real tax rate on my goods or goods minus 0.1% which I've already paid. The difference I will be required to pay. The recipient, that is you, can move the goods from directly either to the port. So you can take the goods from me and directly move it to the port or directly to the registered warehouse from where the said goods will be taken to the port. So either from my place, the goods should directly go to the port. In other words, it cannot be brought to your place and then exported. So it should go directly from my place to the port or firstly from my place to a registered warehouse and from there to the port. Registered principal place of business or registered additional place of business are deemed to be registered warehouse. Now, all this was export of goods. Now coming to export of service. Yes, beta.
Sir, my question is that you were said that supplier pays a tax at the rate 0.01%. And its bifurcation is 0.05% as CGST and 0.05% as SGST. When we add the CGST and SGST 0.05%, it becomes
0.1. And that is why
0.1%.
and that is why saying 0.1 only, but I think there is a typo error here where it is.
Okay.
I'm saying 0.1 only. Okay?
Thank you.
Okay. So now what is export of service as per the definition under GST law? For export, there are 4 conditions to be satisfied. First, supplier is in India and the recipient is outside. This is basic condition. Most important, place of supply should be outside. Third, the transaction should be between 2 different persons and not my own branch outside. So if I'm supplying to my own branch outside, it cannot be export of service. And most important, the amount should be received in convertible foreign exchange. Now, what are the common provisions for export of goods and service? 1. Supplies to SEZ units or developer. Supply to SEZ unit or developer is 0 rated, and whatever is my unutilized ITC, I can always take refund. Conditions. Such supplies are received for authorized operations only. So when I'm supplying to SEZ and treating it as 0 rated to get the benefit of refund, it should be done only if those good services are part of their authorized operations. And second, the officer of the SEZ should have signed on the invoice stating that yes, these invoices are for goods and service which are required for authorized operation. Then only this refund is applicable. Next, transaction with EOU. Supplies to EOU. 0 rating is not applicable because EOU does not enjoy the status as SEZ, but it is, if you remember, it is deemed export. So when I'm supplying to EOU, I'll first charge tax as if it is a normal supply. It may be C plus S, it may be I, and then either me, that is the supplier, or the recipient can go and take the refund. Exports of EOU are eligible for 0 rating. Now, what is the procedure for direct export? That is rule 96A of the CGST rules. Exporter has to execute a bond or LUT before export and pay the tax with 18% interest within 15 days after the end of the month or further period as allowed by commission from the date of invoice issued if goods exported outside India, or export of service 15 days after the end of 1 year from the date of invoice issued if the payment not received by export in convertible foreign exchange. So basically what is this? Whenever we are exporting goods or services, the condition is that we should have received the payment within the specified period or if any further period is allowed by the commissioner. If we cannot receive this amount, then we are supposed to return back the refund which we have claimed along with interest. Further, failure to export and paying tax with interest leads to withdrawal of facility of export without payment of IGST and recovery of the said amount under section 79. So if I fail to pay the amount along with interest, then another punishment is in future I will not be allowed to make export without payment. That facility will be withdrawn. Further, registered persons are eligible to furnish LUT in place of bond, except those who have been prosecuted. So this is a very exceptional point. The details of export invoices should be uploaded in your GSTR1 in the correct table. And then coming to the next part, export to Nepal and Bhutan. Now, export of goods. Such export falls within the definition of export of goods under the IGST Act. RBI allows receiving the payment in INR. It is not necessary that it should be in foreign currency. Why? Because India has a rupee trade agreement with Nepal and Bhutan. They are still treated as zero rated and they qualify for all benefits of zero rating. Non-realization of export proceed within the time will result in recovery of refund. So only relaxation is you need not get in foreign currency, but still you have to get the amount within the time limit. Then RBI allows receipt of payment in INR. Even in case of export of service, you can get the payment in INR wherever export is of services to Nepal and Bhutan. In case of supply of service and such supply in Nepal or Bhutan against payment in INR is considered as export of service subject to fulfillment of other conditions. So in short, for export of goods or service to Nepal or Bhutan, the relaxation is that amount can be received in INR. Correct? So these are the provisions relating to import and export under the GST law. Now we'll take a 10 minutes break. After that, we'll go to the refund part and we'll take some practical questions relating to our today's discussion. In the meantime, I think there is a question Akshay asked. Sir, what was the relevance of adding authorized operation word? Very good question. See, Akshay, SEZs, firstly, when you set up an SEZ, you have to take approval, which is called as LOA, letter of authority, to be acting as a SEZ unit. Now, when you take this LOA, that is letter of authority, in the SEZ Act and rules, a list of activities are mentioned, which are, you can say, the eligible activities which a SEZ can perform. And similarly, there is a negative list which the SEZ cannot perform. Now, when you take this approval of becoming SEZ and you make the application, you have to tick out of the authorized activities which are allowed, what you are going to do. That becomes your authorized operation. Now, when you are given the permission to act as SEZ, it is given permission for that authorized operations only, that is for the approved activities only. You cannot do or you should not do any other activity except the approved. That is where this concept of authorized operations comes in. So if you are doing any activity which is not part of your authorized operations, obviously you should not get any benefit under the SEZ provisions. And hence, even for GST, the condition is continued. Fine, beta? Okay. So now we'll take a 10 minutes break and then we'll come back and we will deal with the other part and the practical questions. Now we are going to go to a technical topic, which is of refunds. Slightly lengthy, slightly technical, but we will do it. Now, what is a refund? See, in very simple words, a refund is a tax or an amount which is paid to the government, but later on, after payment, it is found that one, it was wrongly paid, should not have been paid, so you can demand it back, which is a refund, or it was rightly paid. But like how we studied in the previous chapter, that since it is a zero rated supply, the government itself has allowed you to take back the amount. So where refund arises where the amount is paid to the government, and after payment, either it was a wrong payment, so you are getting it back, or government under some specific provisions has given you that specific facility that okay, you can take back the amount. That is what is refund. Now in this topic, there are three different aspects that we need to study. One, refund allowed in what all cases. Two, what is the procedural compliance, etc. And three, the different types of forms and calculations. Let us start with each of these. We'll try to cover maximum possible. If something is left out, we'll continue it in the next class. So, in what situations the refund may arise? First, either it is export outside India, or it is supply to a SEZ unit or a developer on payment of IGST. Now, this you just correlate with our previous discussion in the previous chapter. So, exports are zero rated, supply to SEZs are zero rated, and for both, which are zero rated, you are given two options. Either first pay the GST, which will be IGST, and after payment and after giving the proof of export, which is happening online only with payment option, refund happens online. Once you upload the relevant details in your GSTR 1 the GST portal matches with the custom portal. This will happen for export of goods, and automatically the refund will come. If it is export of service, you'll have to make an application. Second is you can export or supply to SEZ without paying IGST, that is using the bond or LUT route, which is our second option. In that case, you have not paid any tax on the outward side. But whatever inward side taxes you had paid on all your inward supplies, input service, that is accumulated. Accumulated means you could not set it off. So it is lying as a balance that you can make application and get it refunded. Next, third is refund of tax, which is paid on supply of goods, which are treated as deemed export, where we just discussed in the previous chapter. Either the supplier can make application or the recipient can make application. This is the third scenario of refund. All these three we have already discussed in our previous chapter. Now some other types of refunds which were not covered in the previous chapter. First, which is the fourth one over here, refund of any balance which is lying in your electronic cash ledger. So we deposit money in our cash ledger, and cash ledger is your own money. It is like your money kept with a bank account open with government. So cash ledger is like you have opened a bank account with the government where you have deposited the money. Now, money in your bank account is your own money. Once the purpose of keeping in bank is over, if you do not require it anymore to be kept in bank, you can withdraw it. Same thing is over here. Whatever you deposited in cash ledger, obviously it is for making payment of tax, interest, penalty. Once that is done and you feel now it is no more required, you will not require it in future, you can withdraw it. That is the fourth type of refund under the GST law. Fifth type of refund is where you made a payment of tax, but the supply did not happen. So this will generally happen where you received advance, which is only for service, where as per time of supply, you have to pay the tax in advance. However, later on, the service supply was cancelled for some reason. So you can get the refund. Next, refund could be where you have paid a wrong tax. So tax was wrongly charged and paid to government, which may be either wrong nature of tax, wrong rate of tax, on a wrong value, whatever is the reason, wrong tax was paid. So now you are demanding back as refund. Then a special case where a foreign tourist who has come to India makes some purchases in India, but the foreign tourist is going to take these goods outside India. Now, when the foreign tourist who has made purchases within India is taking these goods outside India, he can take the refund at the time of leaving India from the port airport from where he is living. And at that time, he can file the application and get the refund of whatever taxes he had paid in India. Next, another category of refund is you and department were in dispute. Department made you paid some tax, which you paid, but you are going in for appeal. And after the decision comes in that appeal or in some court ruling, because of that, whatever tax you had paid or the deposit you had paid becomes refundable. Next, you had computed the value, the rate temporarily, which is called as provisional assessment, which is a very rarely used provision in the GST law. At least I have not yet seen in any of my clients' case, or never heard that any of other professionals with whom I'm connected, so many across India, have used this option. But there is an option that where for some reason I am unable to compute the tax liability, I may approach the department. And if the department is also not sure, they will temporarily give me some rate value using which I can compute the tax and pay the tax. This is what is termed as a provisional temporary assessment. Now, this is temporary. Why? Because today I have to pay tax, so I'm doing this. But after this is done, it is my responsibility to get this finally assessed. So a time period is allowed to me by the department within which I'll provide them the necessary details using which they will make the final assessment. If in final assessment it is found that my original tax paid was less, I'll pay the difference. If it is found that original tax paid was more on provisional assessment, I can refund or seek refund of the excess. Next is, if you are a United Nations body or an embassy who is set up in India, you are having a special status whereby your registration number is also not GST and it is UIN. Now, why these are given UIN? For the same reason that when they are making any purchases or they're running their embassies or the organization, they will code their UIN or they will give the UIN to the supplier. The supplier will make supply in the normal fashion. There's no change there. But after they have received these supplies, since they are any of these bodies, they can make a separate application for refund for getting all these GST refunded back, which they had paid on their purchases. Next, if you remember in registration chapter, we discussed that if you are a casual taxable person or a non-resident taxable person, you have to take registration minimum 7 days in advance before the start of that particular exhibition or event. And also you have to pay tax in advance, obviously, which is on some estimate basis. Now, after your exhibition is complete and your actual tax liability is determined, if it is found that the advance tax which you paid was excess, you can go for refund. Now, this is a newly added provision. Actually, this was added to remove any type of confusion, though this is, according to me, a very basic and obvious point, but it was added because there was a lot of dispute in that. Now, what is this? I exported my goods at a price of 100 today. I get the refund as per my first and second point. This point is not for that. But after exporting, after a few months, as per the terms of my contract with that foreign buyer, if there is a rate revision, that was part of the contract that if something happens in future, the rate would be revised. So this export which I made at 100, the rate is revised to 120. What I do, I raise that extra debit note on that person for that difference of 20. But because of this 20 difference, I am also eligible to apply for refund for that excess 20. So there was no specific provision in the law. So there was a lot of dispute whether I will get the refund of this excess 20. So now it is added in the law itself saying that, yes, if there is any upward revision after you have made exports, so whatever is the excess amount, obviously for which you'll be raising a debit note to match that particular increase, for that also refund will be allowed like how it is allowed at the time of original export. And then last is refund of excess payment of tax. So where you can prove that for any reason, either by mistake or under some precautionary measure, you had paid some tax. And then later on, after finalization, it was found that your tax is excess, you can get this refunded. Now comes the second part. Once refund is eligible under any of the above scenarios, you have to run a procedure for getting this refund. Now, this procedure is not required only in one case. That is where it is export of goods with payment of IGST. In that case, this procedure need not be run, because if you remember, while explaining that in the above list, I had mentioned that the refund is automatic. You export goods with payment of IGST option, you file GSTR1, show it as export, file GSTR3B, show it as export, pay the IGST. After you file 3B, your GST portal links with the customs portal, which is called as ICEGate. Both the portal matches the details. Your portal is showing the export, which is matched with the ICEGate portal, which is already having the export details on their portal. If both are matched, you get the refund automatically in your bank. This is what is the automatic procedure. Except this, for all other refunds that we studied above, there is a procedure which has to be run. What is this procedure? This procedure is, whenever you feel that any of the above refunds is applicable, after you have made the payment of tax, filed all your refunds, filed all your returns, now you will make an application seeking the refund, claiming the refund, asking for the refund. This application is made in form GST RFD01, and this is made on the portal, right? Then any person claiming refund of additional IGST paid on account of upward revision, the new amendment part, subsequent to export, and on which the refund of IGST paid at the time of original export, that is of 100, has already been sanctioned, may file an application for such refund only of the additional IGST on the 20, electronically again in form RFD01 through the common portal. Next, any registered person claiming refund of any balance in the electronic rate ledger will again file refund application in RFD01. Similarly, refund of TDS, TCS deposited in electronic cash ledger as excess balance in cash ledger. So if somebody has collected your tax or deducted your tax, then that comes in your cash ledger only. Again, if that cash ledger balance is idle, you don't require it, you can claim it as a refund of cash ledger balance. Next, a person who has been issued a certificate of registration under GST shall undergo Aadhaar authentication for filing of refund application. So before you file refund application, ensure that your GST is Aadhaar linked. However, in case of refund of GST paid on goods exported outside India, there is no need to file a separate refund application. This is what I was mentioning, because this refund is routed automatically by matching both the portals, GST portal with the customs portal. Now, next is the deemed export category. Now, here also, if you remember, I had mentioned it in the previous chapter itself, that here the refund application which has to be filed can be filed either by the supplier or by the recipient. Obviously, by taking declaration from the other party that the tax is not borne by the other party. So if supplier wants to file, the supplier will have to take declaration from the recipient. The recipient will say that I have not given the GST portion to the supplier, neither I have taken ITC, so you can give refund to the supplier. If recipient wants to file, then he will take declaration from the supplier. Well, supplier will say that I have passed on the duty incidence and the recipient has given me the GST portion, so you can allow refund to the recipient. So in both these cases, the application would be made. The application would be made using the same portal and similar form. Important. Entire amount paid by the recipient is available as ITC even if blocked in 17.5. So we all know that there is a 17.5 concept. However, in terms of deemed export, this 17.5 is an exception. It means that where you are making any supplies which is under deemed export category, still the recipient can show it as ITC because it wants to claim the refund of that ITC. So here 17.5 blockee will not apply. Further, there arose a question as to whether the ITC availed by the recipient of deemed export for claiming refund of tax of supplies regarded as deemed export is to be included in the net ITC in the computation. So for this also, the clarification is given that it is not to be included in the computation of net ITC. Now, what is this computation of net ITC? That we'll get to understand when we go to the computation part. So for the time being, in case of deemed export, where the recipient is claiming refund, two important points to be kept in mind. One, even if the supply is falling under 17.5, still the recipient can first show it as ITC, that is claim as ITC and claim the refund. 75 will not affect their refund. Two, while computing the net ITC of the recipient, this particular credit which has come to the recipient, of which recipient is going to file refund, will not be considered in the net ITC computation. Fine. Next is where supplies are made to SEZ unit or SEZ developer, which you all know is considered as a zero rated supply. This is again eligible for refund. But here, if you remember, the condition was that these supplies should be part of their authorized operations, and on the invoice which are raising on SEZ, you should take an endorsement from the respective SEZ officer. Only after these two compliances, when you apply for refund, your refund would be sanctioned, otherwise the refund would not be sanctioned. In case of CTP, NRTP, where you have paid the advance, and after the closure of your exhibition, when you make application for refund, they will reassess or they will check your calculation for that exhibition. After making adjustment of all the taxes payable by you, the balance will be refunded back. Now comes an important point. Very important point is, what is the time limit to make the application for refund? The answer is 2 years. Under section 54, the GST law provides you 2 years to make this application. Interestingly, this 2 years will be calculated from when? So from which date this 2 years should be counted to determine your eligibility? So they have used the term 2 years from relevant date. Now, what is this relevant date? That is what is to be understood, right? We will go to that relevant date point. Relevant date is defined to mean a particular date, which will be the triggering point of your refund. This is the logic. What do I mean by triggering point of refund? That once that particular thing happens on that date, which is called as relevant date, you will be sure that yes, now my refund is applicable. Why? Because that triggering event has happened. So that triggering event date is the relevant date. Now, what are these triggering events which is called as relevant date? This is given in explanation 2 of section 54. What it says? First case, when your goods are exported outside India. Now, what will be the triggering date? The triggering date will be the date of export. That will be the date when you can say, yes, my export has happened. I am eligible for refund. So from that day, within 2 years, you have to apply. So what are these dates? First, where the goods are exported by sea or air, the date on which the ship or aircraft which is carrying these goods leaves India. So the moment the ship leaves India, the aircraft leaves India, your trigger has happened. Where the goods are exported by land, the date on which such goods go outside the Indian borders or the frontiers. Next, when your goods are sent through post, the date of dispatch of the goods by the post office to a place outside India. So you go to your local post office, you'll give that parcel, you'll file or fill in all the declaration forms because you want to export it. That is not the date of export. Then that local post office will send it to your zonal post office, which will ultimately send it to that last post office, or I'll use the word border post office, which will finally dispatch it to that respective country, either through ship or through land route, whatever is applicable. Rarely it is air, generally it is through ship and sometimes through land. That post office, which is, you can say, the last post office, which will finally dispatch it outside India, that date of dispatch is the relevant date. Next, in case of deemed export, where goods are supplied to those 4 cases which are deemed to export, that is under advance authorization, EPCG license, or to EOU. What is the triggering date? The date on which the return relating to such deemed export is furnished. So as a supplier, when I file my GSTR 1 and 3B, in which I have shown this as a deemed export in the respective table, that date is the triggering date for me to get the refund. Why that date is the triggering date? I have already made the supply. But until unless tax is paid, how can I claim refund? And my tax will be paid only when I file my GSTR 3B. So the date of filing of my GSTR3B return in which this particular supply is shown and the tax is paid is the triggering date. It is the date on which I can claim refund. Next, that is from that date, 2 years, I can claim refund. In case of zero-rated supply of goods or service or both to a SEZ developer or a SEZ unit. So we have supplied goods to SEZ or services to SEZ. Now that is also zero-rated. You can claim refund, obviously subject to condition. It is further authorized operation, etc., etc. What is the triggering date? The due date of furnishing of return under 39 in respect of such supplies. So the moment you supply to them, you file the returns. In the return, again, you tick that respective table. So the government comes to know that, okay, you have made that deemed supply, not deemed supply, sorry, you have made the supply to the SEZ units or developer, you are eligible. So date of filing of your returns. In case of service exports, in case of goods export, it was what? Date of leaving of ship, the date of crossing of goods from the land route. But here, service, there is no such date because here it is not being going through some ship or aircraft. Then what? Where a refund of tax is applicable in respect of services themselves. In case of zero-rated supply by notified class of person or supply of notified class of service, as the case may be, inputs or input service used in such service. And now these are the triggering dates. The supply of service has been completed prior to the receipt of payment. The date of receipt of payment in convertible foreign exchange. Second, payment for the service is received in advance, then the date of issue of invoice. So where you have first issued the invoice and then payment is received, the triggering date is receiving payment. If you have received payment in advance and in future you are going to supply the service, that is export the service, the date of issue of invoice, because that will represent the provision of service. Next, when refund becomes eligible, why? Because of some degree or judgment of the court, then the relevant date will be the date of such degree or judgment, because that is the triggering point. Next, in case of inverted duty structure, what is this inverted duty structure? If my output rate is less, let us say 5%, and the input rate, that is the raw materials and a packing material which I'm purchasing at 12 or 18%. So we say that my business is under inverted duty structure where the output tax rate of my output is lower as compared to the tax rate on my inputs or input services. In such a case, I can apply for refund under the inverted duty structure category. What is the date? The date is furnishing of my returns. When my returns, whenever that month's return is filed, because that month's output rate is 5, that month's input rate is 12, 18, I will apply for refund. In cases where tax is paid provisionally, what is the triggering date? The date of final assessment, because on that date, it is decided what is the correct tax. So you can file refund application within 2 years after that date. In case of a person other than a supplier, that is where the refund is demanded by the recipient, it is the date of receipt of goods or service by the recipient. And in any other case which is not covered above, it is the date of payment. This will happen when there is wrong payment of tax. For those cases, 2 years will be counted from the triggering date, which is the date of making payment of this tax. This is an important part, students. I will request that you should learn this table. It is an important question which is asked in the exams. Now comes the next part, that is bunching of refund claim across financial year. Now, what is this bunching? So, if you see the portal is designed that in such a manner that if you are a monthly return filer, you can apply for refund application monthly, one option. But many times it is very cumbersome filing every month refund application. So what people do is they let 5-6 months pass, and then for all those 5-6 months, they file one common refund application selecting those 5-6 months together. This is what is bunching. Now, this is okay. The challenge was, what if I want to club 3 months from this year, let us say January, February, March, and 3 months of the next financial year, April, May, June. Can I do that? Can I bunch the months falling in 2 financial years? Now they have said that earlier there was a restriction on this. Mainly it was a restriction by the portal. Then after a lot of dispute and so many things, now it is clarified that you can do this. So even now you can bunch periods from 2 different financial years in one refund application only. Most important, What are the documentary evidence for filing refund application? See, there could be n number of documents, which will depend upon the nature of application which you are filing under which category. The only logic or simple point to be understood and remembered is, what are these documents? The answer is the documents which will prove your eligibility, one, to the refund, and two, if you are claiming, for example, refund of ITC, then whether that ITC is correct, whether it is genuine. So these are, in simple words, the documentary evidence, right? Now, what it says, section 54.4 stipulates that the application shall be accompanied by one, such documentary evidence as may be prescribed to establish that a refund is due. Second, such documentary evidence to establish that there is no unjust enrichment. Now, what is this unjust enrichment? This is a very important concept, especially in case of indirect taxes. This will not come in a direct tax scenario. It will only be in an indirect tax scenario. What is this unjust enrichment? See, unjust means unfair. Enrichment means getting benefit. Now, what is this unjust or unfair benefit in case of income, GST or any indirect tax? See, what happens in case of indirect tax? As a supplier, I have all the rights. In fact, I'll say right given by the law also to recover the GST from my recipient. So whatever GST is applicable on my supply, the law allows me to recover this from the recipient by adding it in the invoice. Now, if let us say I have charged the tax in the invoice, recovered that GST from, in future, it is found that this was a wrong tax paid. Now, since I am in the business, I will come to know it easily that this is the wrong tax paid. I should have paid at 12, I have paid at 18. I will smartly do what? I'll go to the department, means I'll make an application and ask for refund of that excess 6%. But is it genuinely correct? Should I be allowed the refund of that 6%? Answer is no, because of this theory, this concept of unjust enrichment. What is this theory or concept? It says that only the person who has received that tax, not received, who has borne the burden of that tax is the person who is eligible to file the refund. So, if I have passed on the tax burden to the recipient, how? By adding it in my invoice and recovering the tax from the recipient, then now the burden is on the recipient. The recipient has paid the tax out of his pocket. So it is only the recipient who will be eligible to take the refund and not me. If I take the refund, then it will be unjust enrichment, unfair benefit to me. Because what is not paid out of my pocket in the first place, how can I get refund back in my pocket? But if I'm getting this, that is unjust enrichment. And this is a very important doctrine principle applicable in refund claims, especially in case of indirect taxes. That is why two things you have to establish through documents. So one, your eligibility for the refund, and two, that nobody else has borne this burden. So it should be only you, because there is no unjust enrichment in that. Next, wherever your refund application amount exceeds 2 lakhs, in that particular case, you will have to get a certificate from the CA, CW, etc. Now, different types of documentary evidence list is given. What would be the different types of documents? We can go through them. The simple logic you should remember. These are those documents which will prove that you are eligible for this. So these are the documents list that are given. I'm not reading it through. You can always go through that. Then that 2 lakhs amount where it is exceeding 2 lakhs, you have to take a certificate from a CA or a CMA. This is the certificate format given in the rule itself, in which you have to take the certificate. Now, something new has been brought in the law. What is that? Manner of filing this refund application by an unregistered person. Now, somebody will think, sir, how can an unregistered person apply for refund? Or before that, before how, in fact, that is what is they have prescribed. Before that, what will be the scenario when an unregistered person has to get a refund? The answer is when this unregistered person is the recipient or the buyer. So let us say I am the supplier. I have charged tax on you, that is on the supply. I have charged the tax, I have recovered it from you. You are a buyer who is unregistered because you are a consumer. You are not in business. Now tomorrow, if it is found that this refund is eligible, why? Because I charge a wrong tax or at a higher rate. In that case, when you will go for this refund, the refund should be allowed to you. But how and when it will be allowed? When you will be in a position to file the refund application. Now, what is your challenge? Your challenge is that you are unregistered. You do not have access to the portal. So, for such scenarios, a special procedure has been prescribed. Now, this procedure is mainly or majorly, I will say, applicable in case of builder. So, I am a builder. I levied tax on you because you booked some flat or shop or office in my building while it is under construction. So GST is applicable. Later on, for some reason, you cancelled this contract. So I refunded back the amount to you, but I said, Baba, GST I've already paid to the government. If you want, you can go and take it from the government. So many times builder used to do this. Now you are left with this problem that since you are an unregistered person, you have no option because you don't have any mental ID access. So for them, a special procedure has been provided whereby the section itself, instead of using the word registered person, has used the word any person. So the section firstly provides that any person, even who is an unregistered, can apply for refund. And for them, now the portal has brought in a new category, which is refund for unregistered persons. So the same RFD 01 has to be filed. If the amount exceeds 2 lakh, you have to take the certificate. So everything is same. The only thing is that a new category is open in the portal. Right? Now we come to the main part, that is what is the detailed procedure of getting this refund. So procedure of receipt of refund claim. So once I have filed the refund application under that rule 89.1 in RFD 01, the next step is acknowledgement of the refund application or refund claim. Where the application relates to claim for refund of electronic cash ledger, an acknowledgement in the prescribed form shall be made available to the applicant, clearly stating the date of filing the claim. Fine. Other refund claims, the application shall be forwarded to the proper officer. So in short, where it is refund claim for your cash ledger, nothing has to be checked. The portal itself can check whether that cash balance is there or not. The portal itself will give you acknowledgement. But for all other claims, export refund, excess tax paid refund, in all other cases, we need to first check whether you are genuinely eligible for the refund or not. So in those cases, your application will be forwarded to the officer. Then the officer within 15 days will ask you to provide all the details, documents, etc. And then the officer will scrutinize your application on the basis of all these documents, and only on being satisfied that everything is correct will give you an acknowledgement in the prescribed form, obviously through the common fold. The refund acknowledgement will clearly indicate the date of filing of refund claim. Now comes interesting part, which is called as deficiency memo. You have filed the refund application, but I find that there are some deficiencies in your refund application. So what I do, I will give you a deficiency memo and ask you to refile your refund application afresh next time by removing the deficiencies. So this is what is the deficiency memo rule. So I will communicate the deficiency and you will have to then refile this claim, removing the deficiency. Next is withdrawal. The applicant may at any time before issuance of the sanction order, either provisional or final, can withhold or withdraw the application by filing an application in the prescribed form. So let us say you made an application. Later on at your end only you discovered that, okay, something wrong happened. Either the application amount is wrong or you are not eligible, but you wrongly believe that you are eligible. So you file the application. and you do not want that this should become a fraudulent refund case, because tomorrow if officer identifies that you are trying to take a refund in a wrong manner, he may even levy penalty or punishment on you. So you don't want to do that. So you are given an option that before he sanctions your refund, you have an option of withdrawing your application, for which again you have to make an application. Now, the second step is after you have filed an application, after he has acknowledged your application, now if he finds things are proper, the law says that he should immediately give you a provisional refund of 90% of your total amount. This provisional refund should be done within 7 days of giving of the acknowledgement of accepting your application. Remaining 10% can be refunded later after proper verification of documents. The provisional refund would not be granted to supplier who was during any period of 5 years preceding the refund period prosecuted for any offense exceeding 2.5 crore. So for such people, that 90% immediate refund will not be granted. For others, the law provides that after an acknowledgement is given by the officer, within 7 days, you should get the 90% amount and balance 10 after he verifies the other details. Now, there are some procedural points here that you can read. Then comes the refund order. Now, after verifying all the details and being assured that yes, your refund application is correct in all respect, he will give you the final refund order, and also he will grant the balance amount, whatever is left. Refund to be granted both in cash and credit based on the original mode of payment. Now, this is interesting. I sanction your refund of, let us say, 100 crores. Now, when I have to give you this refund, how will I give you? I will not transfer the money in your personal bank account. See, this refund has arisen because you paid tax. Now, how did you pay tax? You paid tax either by utilizing the cash ledger or by utilizing the credit ledger. So what I will do is, where you paid this tax using your cash ledger, I will transfer the refund amount in that cash ledger. Where you paid this tax using the credit ledger, I will transfer the amount in your credit ledger. So this is how the refund would be granted. Where the proper officer is satisfied that the refund amount is refundable under these rules, is payable to the applicant, instead of being credited to Consumer Welfare Fund, he shall make a refund order in the prescribed form and issue a payment order for the amount of refund. So after verification, if he finds that in all respects your refund application is correct, complete, he will not transfer your money to the Consumer Welfare Fund, but grant you the refund. Now, this point will be discussed more in further pages or further provisions. What is this point? Now see, let us say, now understand this point, wrong tax is paid, excess tax is paid. You file a refund application, but it is later on found that first, wrong tax is paid, that is agreed. But it is found that you have not borne the burden, it is borne by the consumer who has finally purchased these goods or services. But the consumer is not traceable because he was some walk-in customer, he bought the goods and he went. You were smart enough to identify that this is wrong tax payment. You went for the refund application, you will not be granted the refund. Why? The simple reason is because you have not borne the tax burden. Now, but since the tax was wrongly paid, so the tax is eligible for refund, but you will not be granted the refund because you have not borne the burden. In this case, the interesting thing is, can the government deny the refund? Answer is no. Because if the government deny the refund amount will be kept with the government, that is, it will be in the pocket of government, which will again be an unjust enrichment. Unjust enrichment is not applicable to you and me only, that is only to taxpayers, it is also applicable to government. This was a landmark decision in Nafatlal Industries, from where the concept of unjust enrichment has been brought in taxation law, especially for everyone. What does that judgment says? That if any amount is wrongly paid, so that amount cannot be even kept by the government. Because if government is keeping a wrong amount with them, it is again an unjust enrichment done by the government, which is against constitution. So like how a businessman cannot be unjustly enriched, Similar to that, even government cannot be unjustly enriched by taking a wrong refund. Hence, this concept of consumer welfare fund has come. What it says? The two things. First, I have to check whether the amount is refundable, and second, whether you are eligible to get the refund. Now, if first step is satisfied that yes, the amount is refundable, that is agreed. But the second is not satisfied, boss. You are not eligible for refund. Why? Because it has not gone out of your pocket, and the person from whose pocket it has gone is not traceable. In such a case, the provision says even the government cannot keep the amount, so we will transfer this amount to a special fund, which will be used ultimately for consumer benefit, called as the Consumer Welfare Fund. So neither government will use it, neither you will be given the refund. This is where this concept of Consumer Welfare Fund has come into picture. So how the provision is designed? So one, it is proven that refund is eligible, and second, you are eligible to take the refund. When both the conditions are satisfied, the refund order will be given in your name. If the first is satisfied but the second is not, the refund will be transferred to Consumer Welfare Fund. Neither government nor you, nobody will be eligible to keep the refund amount. Where the proper officer is satisfied that the amount refundable under these rules is not payable to the applicant, he shall make the refund order and credit it to the Consumer Welfare Fund. So it will be going out of government's pocket to the Consumer Welfare Fund. Next, time limit for giving this order. Refund order shall be issued by the proper officer within 60 days from the date of receipt of application, which is complete in all respects. Now, you make application. First, the officer can give you deficiency memo, which is as good as rejection, and you have to refile. But instead of doing that, what the officer can do as an interim stage, he can issue you a show cause notice. Now, what is this show cause notice for? Where you have made a refund application and there are some small, you can say not defects, but there are small things. Sorry. There are small things on which the officer wants some more clarification or wants some more documents. In such a case, instead of rejecting the refund application, the officer may first issue a show cause notice in which the officer will ask you to provide those additional details, to provide those additional documents to prove your claim. If you are able to do that, your refund will be sanctioned. If not, despite of giving this show cause, if you are not able to stand by your claim or prove your claim, then the provision says the officer can reject your refund claim. So that is what is the provision. For this, you are given 15 days to reply to the show cause. If you do not make the reply, still he has the power to reject your refund claim. Ma'am, you have to make any announcement?
Yeah, hello, good evening, students. We have an important announcement for you. Now we are, starting with a open house query sessions for the final students, and it says BOS believes in you. Let's conquer CA final together. So we are starting this interactive session, open house query session. We are starting from Monday onwards, and for each subject there will be one session every week. And the timings for the session will be 4 p.m. to 5 p.m. And it will be an open house session where you can engage in live sessions with the faculty members for doubt clarification, conceptual understanding, and academic guidance. So let me show you. See, this is the session we have. BS believes in you. Let's conquer CA final together. So it will be an open house query session starting from 16th June 2025, and weekly basis for each subject. There will be a clarify subject related queries, doubt clearing session, academic support on how to clear exams, along with boosting your preparation for the examination. So be there in the large numbers. All of your friends who are not joined these classes yet, who are not there online, you may inform them so that they also get benefit of these sessions in large numbers. And we are starting this from 16th. On 16th of June 2025, the session will be on financial reporting. Then 17th June, they will be on advanced financial management. 18th June, advanced auditing, assurance, and professional ethics. 19th June, DT and international taxation. 20th June, indirect tax laws. Now you can join the session by scanning the QR code, the flyer which I am showing to you. Further, this will be shared to you in the final LVC group, and a mass mail will also be shared with you. And shortly, an important announcement will also be hosted on the BOS Knowledge portal. So be there, and we see you in this session. I am sure that large number of students must be waiting for this session so as to have one-to-one interaction with the faculty, and they would like to clarify any subject-related queries, some doubts which they are in their mind. So please be there sharp at 4 p.m. to 5 p.m. open house session, and any student can join this session. So that's why I'm telling you, anybody who is not in virtual class, tell your friends, colleagues, so that they also get the benefit of this class. Okay? Okay, thank you. Over to you, sir.
Thank you, ma'am. Thank you. So students, please make a note of this announcement. This is a very important and crucial announcement for all of y'all, and it is going to be of a big benefit, and I believe it will be a game changer for the upcoming exams. So please note that you will take the maximum benefit of this special facility which BOS has come out with for your benefit exclusively. Let us complete this point today before we close. So next part in the refund procedure is withholding of the refund claim. So where an order giving rise to a refund is subject matter of appeal or further proceedings, or where any other proceedings under this act is pending and the commissioner is of the opinion that grant of such refund is likely to adversely affect the revenue in the said appeal or other proceedings on account of malfeasance or fraud committed, he may, after giving the taxable person an opportunity of being heard, withhold the refund till such time as he may determine. So refund application made, either he gives refund, he passes, or he gives a deficiency memo, or he can issue show cause, and on that basis of reply he may accept or reject. But in all this there is one more, that even after passing of refund, if there is found that there is some proceedings pending against you, there is some other tax pending against you, so they have the power to withhold your refund. So this is an important point which is a part of the refund procedure. So 5410 stipulates that where any refund is due to a registered person who has defaulted in furnishing any return or who is required to pay tax, interest, penalty which has not yet been stayed by any court, tribunal, appellate authority by the proper officer may withhold the payment of refund due until the said person has furnished the return or paid the tax, interest, penalty as the case may be, or deduct from the refund due any tax, interest, penalty or any other amount which the taxable person is liable to pay but which remains unpaid. So this is what is the provision. And then 5411 says, where an order giving rise to a refund is the subject matter of appeal or further proceedings, or where any other proceedings under this act is pending, the commissioner is of the opinion that grant of such refund is likely to adversely affect the revenue, he may withhold the refund. Next, credit of the amount of rejected refund. So if your refund claim is rejected finally for any of the grounds or any of the reasons, in that case, the authority will then have the power, not power means they have already rejected. So now, whatever is the amount of refund which you are seeking, that amount, if it is debited originally at the time of making the application, it will be recredited to your electronic credit ledger. So whenever you make an application for refund of unutilized credit, that much amount is deducted from your credit ledger. Now, since the refund is not being sanctioned, it is recredited to your credit ledger. So students, this is all about the refund up to this point. In the next class, we'll continue from this point, which is a very important part, as I already mentioned. principle of unjust enrichment. So with this, we close our today's session. In the next session, we start from here. I hope you all understood all the aspects. Today's both these sessions were slightly technical. They were very interesting. I'm sure you all were able to understand. If anybody has any particular questions, you may please feel free to ask. Neha, you have any questions, beta?
No, sir, not right now. First, I'll revise, then I'll ask.
Yes. So these are technical, so I'll request that you all revise so that it will be more easy for you to understand. Fine?
Yes. Sir.
So thank you all. Thank you very, very much. And we
Thank you,
connect in
sir.
the next
And good
class.
night.
We connect in the next class to take ahead this. So thank you all. Ashok ji, thank you. Good night. Yes, sir. We can close. Good night.
Thank you, sir. Thank you. Thank you, students. Thank you, sir.
Thank you, sir.